Hi, this is the RITE Report show for the month of April, and I'm your host, Chris Angle. I'm the editor-in-chief of the RITE Report, and along with me is my co-host and collaborator and a venture capitalist on the West Coast, Rick Samuelson. Good to see you, Rick.
And you. Glad to be here.
Once a month, the RITE Report puts out a predictive piece on the direction of the stock market and the economy. The website to visit is stock-market-direction.net. And so this month we're going to do the month of April, and the name of just to give you a little introduction, the RITE Report's name was derived from the acronym Risk, Information, Time, and Effort. And of course this would be for a service, and if the product were a material, there would be an additional factor of land, or as the economists would say. The RITE Report generates indices from the monthly compilation of corporate, business, economic news generated mostly from governmental sources, but some private sources are thrown in. These news indices are used as factors for prognostication of the market direction, and as such, the RITE Report pretty much for the most part eschews technical trend analysis and relies mostly on fundamental news analysis. And if you have a comment, you can give us an email at RITE report @gmail.com. So let's go to the RITE Report, and as from the website, as noted in the website, and then we'll ask Rick for his general comments on the stock market. So the RITE Report came out on April 8th, and its executive summary was that we should stay long on stocks, and that the index, the RITE Index, which is generated monthly, is pretty high at 84%, and it's up slightly since last month in March. Overall, the economy is in good shape, with 16 out of 25 RITE Report economic indicators being positive, and we'll go over those in a few minutes. So if you want to stay with us, we're going to go over the full report. And first, what we do is we take the macroeconomic news on the negative side, and we list those up. As you can see, we take from the governmental sources, such as the U.S. Census. And the first one that came out on March 11th, total business end-of-month inventories and U.S. total business sales were 1.45 billion, down 1% from last month. Also from the U.S. Census, seasonally adjusted after-tax profits for retail corporations were down about 3.4 billion from the third quarter. Manufacturing corporations' seasonally adjusted after-tax profits were 154 billion, which is down 1.7 billion from the third quarter. Sales of new single-family homes in January, where it says we're at is 6.9% down, below the December estimate. And the reason why it's December is that there was a government shutdown, so they're still trying to catch up on this one. Privately owned housing starts in February were at a seasonally adjusted annual rate of about 1.1 million. This is 8.7% below January. Personal income decreased 22.9 billion in January, and disposable personal income decreased by $34.9 billion. However, personal consumption expenditures increased $8.6 billion. But overall, this piece of news goes into the negative column. Sales for new single-family homes in February were at about 667,000. This is 4.9% above the January estimate of the revised estimate. So of 600, well, perhaps this should have gone in the positive one. The U.S. retail and food services sales were decreased 0.2% from the previous month, and new orders for manufactured durable goods decreased 1.6%. So we've got about 8 or 9 negative snippets here and positive snippets from also from the U.S. Census. U.S. food and retail service sales increased 0.2% from the previous month. From the Bureau of Labor, the real average hourly earnings increased 0.3% over the month in February, and average hourly earnings increased 0.4%. Real average weekly earnings decreased 0.1%, but overall we're going to put that in the positive section. Total construction activity was 1.3% above the revised December. And then new orders for manufactured durable goods increased 0.9 billion or 0.4%. New orders for manufactured goods in January increased about 0.1%. From the Bureau of Labor Statistics, in 2018, multi-factor production grew at 1% annual rate in the private non-farm business and private business sectors. In both sectors, multi-factor productivity grew at a faster rate than in 2017, so clearly a positive development. Also in March, the estimate of U.S. selected services total revenue for the fourth quarter was an increase of 1.2% from the third quarter and up 6.3% from the fourth quarter of 2017. U.S. selected services total revenue for the fourth quarter was an increase of 1.2% from the third quarter, and the January 2019 sales of merchant wholesalers were up 0.5% from last month. The CPB monitor, World Trade Monitor, shows that the volume of world trade increased 2.3% in January. And the U.S. Bureau of Economic Analysis has issued the following news release. Real gross domestic product increased 2.2% in the fourth quarter of 2018. In the third quarter, real GDP increased 3.4%. Total construction activity for February 2019 was 1% above January, and total U.S. business sales were up 0.3% from last month. Also from the BLS, total non-farm payroll employment increased by 196,000 people in jobs in March, and the unemployment rate was unchanged at 3.8. However, we're going to put that in the positive, even though it was unchanged, because it's a good number of, because it's a notable job gain. And so, if we take a look at, we've got about 40% negative and about 60% positive as far as news indicators are concerned. And so now we're going to take a look at a lot of these indicators, and we're going to put them into a section here. for economic indicators, and one of them that we use is the high yield bonds, which increased from 85.10 to 86.43, and this is by the ETF called HYG, high yield bonds ETF. Another ETF that we use as an indicator is DVY, and it's the iShares Select Dividend Stock ETF, I should say. And it over the last month went from 97.28 to closed in beginning of April at 100, so it's positive. And the Purchasing Managers Index is at 55.3. It's positive, so that shows the economy is expanding. Construction spending is 1.1% up, and so that's positive. And the Bureau of Labor Standards, the unemployment overall, we're going to call it negative because it's unchanged at 3.8, but which is okay, but the participation rate decreased, and the employment to population ratio decreased, negative. So, and but the employment trends index at the Conference Board increased. So we've got one neutral, two negative, and one positive. So it just makes a negative column. The productivity is positive. All sections were showing increases in productivity. The quarterly financial report for manufacturing, mining, wholesale trade, and selective service industries was the profit after tax profits was slightly down, so we're going to call that negative. Our retail sales was neutral. It's basically was about the same. So so we had a decrease of 0.2%, but an increase. It's an increase over 2.2 over the same year last year. Manufacturing and trade inventories and sales was up 2.8%, so we're going to call that positive. Our industrial production index called INDPRO, and this is put out by the Federal Reserve of St. Louis, and it upticked. So and further year-over-year comparison is positive. So both the production, industrial production upticked, and compared to a year ago, it's positive. So overall, we're gonna call this a positive. And the RITE Report considers this probably one of the most important indicators of all. Another really important indicator is the velocity of money, and it upticked also. And that's also put out by the St. Louis Federal Reserve. New residential construction, we're going to have to call this negative. It was down 1.6%. And the Conference Board leading economic indicators increased. And the coincident economic indicators put out by the Conference Board also increased. So both positive there. New residential sales was up 0.6%, and that's positive. And the advanced report on durable goods decreased, so we're going to put that in the negative. Existing home sales put out by the National Association of Realtors was up 11.8%, so clearly positive. And real GDP was up, is at 2.2%, so that's positive. And personal consumption expenditures put out by the Bureau of Economic Analysis was decreased 0.1%. So negative. Personal income down 0.1%, and consumer confidence was decreased as noted by the Conference Board. So also the restaurant performance index is above 100, so that shows that industry is expanding, And this is a leading economic indicator, by the way. People tend to use restaurants as a when they're feeling good, they go out to eat. And corporate profits have decreased, so that's negative. Manufacturer shipments, inventories, and orders increased, so that's positive. And the World Trade Monitor, which we reviewed in the notes above, was increased, and so that's positive. And so there are 16 positive indicators, 8 negative, and 1 neutral. And that's how, and we compute that all together using also this index, which is we judge that our domestic political risk is excellent. So we judge our tax risk excellent because corporate taxes have been cut. Individual freedom is doing well because regulations are being decreased, and there's corporations are producing a lot of knowledge because they're doing well as a whole. And if we take a look at the technical analysis of the stock market, it seems to be in a long-term bull. General business and economic snippets, as we noted above, is 61 is high at 60%. So, and the economic indicators, as we indicated, are 16 positive, 8 negative, 1 neutral, and so we're going to judge that at 6.8%. So the RITE strategy index upticks to 84%, and so overall at 84%. We have to think that the stock market is going to proceed continue its upward climb for the nonce. So let's go over to Rick and see what he has to say about the stock market. Rick?
Well, I think it's interesting. If you read the headlines, newspapers in recent months, none of this was supposed to be happening. The China trade dispute alone was allegedly going to derail the global economy. Instead, the economy seems to be continuing on a steadily growing, non-inflationary path. There was a hiccup because the Fed has raised interest rates. They put a pause on that. The stock market bounced right back. What I think is underappreciated, although you made note of it here, is that the positive effects of deregulation, continue to buttress business making decisions that lead to expansion. And there's a confidence that the Trump administration is not going to turn back the clock on deregulation. And I would add, there's a growing confidence that Trump will be reelected in the business community. And that's really one of the things that's feeding a generally positive environment for not only fundamental economic growth, but risk-orientated growth. Look at the IPO market. The IPO market is as good as it's ever been. We're seeing new companies getting a lot of traction. Admittedly, the Lyft IPO, which was overpriced, has had a bad spell, but numerous biotech IPOs are coming out. The valuations are generally good. And all of this is positive for the future of the American economy. I would add that if this divergence between official unemployment, and labor participation could be addressed very easily by lowering immigration quotas. The United States, uniquely in the world, has to start with, adding 1 million people a year, irrespective of economic conditions, to the American economy. And so making progress on labor participation is extremely difficult. It's also extremely difficult, given that reality, to improve wages per hour. That is happening. It's happened, rather belatedly, and wage stagnation is perhaps one of the most important economic tragedies of the last 20 years, frankly. Even as other essentials like healthcare, education, the scandalous increases in both of those parts of the economy at the expense of general taxpayers. This has continued mostly unabated and has never really been addressed by the government. So I think the fact that the U.S. economy, when it struggles against these negatives, it is a remarkable performer. And comparing it to Europe, where overregulation has killed most economic incentives, the United States comes out a winner every time.
Rick, what do you think overall? Is it a good time to be in the stock market now and to invest in the stock market?
Yes. Would you want to be in bonds?
Right.
Look at the yield. There's some scope. What's interesting is I do some private lending, and it's not uncommon to see 10, 12, 14% interest rates in the private lending market. And this is all risk capital. And these are companies, if they are borrowing money to expand, what they're doing is funding inventory, they're growing their businesses, they are having to raise money very, very quickly to expand. And there are numerous private lending opportunities out there now, which excludes the banks. These are private arrangements between one individual and a given company, and this sort of lending is flourishing. So if I were to, when I look at fixed income opportunities, I look to that market first.
Rick, thanks very much for your advice here on the RITE Report for the month of April. And we'll see you next month in May, and probably around the 10th we'll put out our next report for the RITE Report. Thank you.
Thank you.